Huge companies in Australia are now losing tens of millions. Core Lithium just said it's going to close its Grants mine near Darwin. 150 jobs gone. Savannah nickel mine closed a few days later. 140 jobs gone. The battery minerals sector has been taking it on the chin. Well, it's early February. Welcome back to another pod. There's lots to discuss. Unfortunately, not all of it's great, especially as it relates to mining. Gold continues to trade sideways above 2,000. The real story is obviously lithium's collapse, prices collapsing, spodumene to under $1,000 US. Incredible collapse. Huge companies in Australia are now losing tens of millions. Core Lithium just said it's going to close its Grants mine near Darwin. 150 jobs gone. Savannah nickel mine closed a few days later. 140 jobs gone. The battery minerals sector has been taking it on the chin since late 23, and that trend has carried over into 24. And unfortunately, it looks like it's going to have to get a little bit worse before it gets better.
Is this a knee-jerk reaction, or is this based in truth and fundamentals? There's been some bad news in respect to the EV industry in particular. Now, are these actual fundamental shifts? Potentially. I'm not a huge bull on EVs taking over our roads in 20 years. I don't necessarily think that's going to be the case, but again, we don't need them to take over the roads to really have a big boom in the lithium industry. We need like 10% of the cars on the roads. Now, Hertz, the rental car business, obviously reducing their EV fleet by, I think it was 20,000.
Yeah, it was like 14 or 16,000. It was a huge hit. Yeah.
Okay, it was a huge hit, but more importantly, it was a headline that really grabbed the industry's attention. It really created a negative sentiment. And some of the automakers obviously are scaling back their production on EVs. So obviously the price of lithium, I think, contracted due to that, due to some of the fundamentals out of China. But I do believe there will be breakthroughs in the battery space that revitalize the lithium industry probably in the next 12 to 18 months. And I know Toyota has made a breakthrough in that regard. We'll include some links in the description because I don't have the expertise to speak to it. But they're talking about 1,000-kilometer range, which I think is the big resistance point for consumers right now is if I buy an EV or if I rent an EV, where do I charge? How long will it take to charge, etc. Yeah. So I think this is a bit of a knee-jerk. I think lithium will come back, but it's definitely the sharpest bearish reversal we've seen in the industry probably ever, and at least since 2016.
Yeah, there's a percentage of consumers and the population who, if they value their time and they value, reliability, they're just not ready to make that switch yet. And yeah, of course, I mean, the tech's going to get better, the range will get better, the charging will get faster, and I think you'll see this slow, steady grind up to 10%, 20%, 30%, but it's going to take a lot longer than a lot of these government policies suggest. The billions and billions that went into, exploration and development of so many of these lithium projects, cobalt projects around the world, flooding the market with supply. The price has to move a lot higher for so many of these projects to be viable. Peter Kerr came out in January, the 8 mines most at risk of closure amid a battery metals slump. And it's all about these mines in Australia, most of them, lithium, cobalt, nickel, that are losing not a little bit, but a lot of money, tens of millions, 50 million, 100 million. One of them just lost 66 million in the last 9 months through to September 30th. You can't run a mine that's losing 20, 30, 40 million dollars a quarter. Prices are going to have to bounce back in a big way. Let's talk about the industry kind of in more broad sense. S&P Global Market Intelligence, they came out, in the middle of last year. Discovery to production averages 15.7 years. Okay, they looked at 127 mines. The time that it's taking to move these projects from discovery through to production continues to go up, up, up. The most challenging thing in mining is timing the cycle. So many companies, you can raise money. Okay, things are hot. All right, lithium price will move. Okay, let's go. Okay, we got to raise $10 million. Okay, we got to drill. Let's get this thing permitted. By the time you're ready to finance for construction, the cycle has moved on. The price of lithium or said commodity is now going the other way. You miss the window because as the time to move from discovery to production gets longer and longer, right? It's never going to be the first company that moves it into production, right? They're going to get it started. They're going to make the discovery. They're going to put, 10, 20,000 meters in the ground, and then they're going to go bust, and they're going to sell it for pennies on the dollar to company B, who's going to take it this far down the field. And then, maybe there's enough time to make a production decision. Oh no, cycle's going down, bust again. Now they're going to sell it for pennies on the dollar after putting in, 50 to 100 million or however much. And then maybe it's that third company, fourth company, 10, 20, 30 years down the road that's actually going to get the project early enough in the cycle to finance it for production, move it through, and actually make money. And then even once they get into production, they're going to ride the waves of profitable times and not so much. And that's the hard truth when it comes to mining. And investors have to understand, you're not going to be able to see this thing through. Cycles only last a certain amount of time, and you have to have your exit in mind when you buy into these deals, right? That everything's not going to work out and the sentiment is not going to be static or improving for the next 15.7 years as it moves from discovery to production.
If we're just talking from the investor perspective, so the macro issue in mining these days is it's a long lead time to go from discovery to production. And it's growing. It's only getting bigger. It doesn't matter where you are, even if from Africa to the U.S., which is has one of the strictest regulatory regimes for mining on the planet, to Canada. The lead time it takes to go from discovery to production is astronomical. Me as an investor, let's just look at the juniors. And I don't like calling them junior miners. I like calling them junior explorers or junior developers because they're not mining. They're exploring or they're developing a project so it can become a mine, hopefully. So if I'm going to go out and buy a junior explorer, let's say greenfield, my objective with that investment is to buy shares cheap, hopefully beat the discovery. My purchase time is supposed to be ahead of the discovery. And then at the point of discovery, which is hopefully big and promising and everybody's optimistic about it, I'm either going to sell the entire position or a part of the position, depending on the capital the company needs over the next 12 to 24 months. If you have a junior exploration company who is working on a prospective greenfield project right now, they're going to raise capital. Let's say they want to do a 10,000 meter drill program. I don't care where it is. Let's say it's in Canada. They're going to have to dilute, unless it's a stout management team with a history of building mines or being bought out. That 10,000 meter drill program, that first drill program they're going to do, it's probably going to dilute their company by 50%, given today's valuations. So you're going to go invest in a company that's going to give up half of its ownership to go drill 10,000 meters. If they don't hit, that company's screwed, and so are its shareholders. If they do hit, hopefully it's big enough that the shareholders will have an opportunity to evaluate if they want to continue holding on to a resource estimate or perhaps even longer to something like a pre-feasibility. But for an investor to go buy a junior exploration company right now, whether it's greenfield or brownfield, and say, I'm going to buy this.
And that's generally speaking, obviously, right? Like there's some companies where, the founders will put in $4 or $5 million and the structure is very tight and, what have you. But yeah, generally speaking, if they don't have guys who've sort of been there and done that before and it's not structured, just that way.
What I'm saying, to clarify what I'm saying is if you take a junior explorer right now who has a greenfield project or a pre-resource estimate project, chances are their valuation is below, 15 or even $10 million right now. Okay.
Yeah.
So a 10,000 meter drill program is going to cost them probably $3-4 million, let's say, including G&A as the time goes on. So let's say it's $3-4 million. So you're giving up 30-40% of the company to go drill that 10,000 meters right now in that particular instance. All I'm saying is, given the timeline from discovery to production, which is basically a generation, I don't know anybody who has that time frame unless you're some sort of billionaire and you're just going to invest and forget about it and you're doing 50 of these. Yeah. But you're trying to be there for phases. You're a bridge. You're a bridge type of investor. You're the resource estimate investor, or you're the feasibility investor, or you're the production investor. Decide who you are when getting involved in these pre-production scenarios, because nobody can wait, and dilution over all those years is a killer. It's killed many shareholders out of great projects.
So true. And Rio Tinto, the fourth or fifth largest mining company in the world, perfect example. It took them 27 years to bring their iron ore project in Guinea, West Africa, into production. They had 6 CEOs during that time. They tried to get rid of the asset. They tried to sell it. They were in court multiple times getting sued. And I think they have 8 or 9 different partners. They had 6 or 7 different Chinese conglomerates. They had to partner with the government of Guinea. They had another couple partners. It's a very complicated project. They have to build a railroad, I think 400 or 500 kilometers to the coast. They're going to build a port facility and all these things. If it takes a company that basically has limitless capital and expertise at their disposal, 27 years to get a mining project from discovery through to production. What chance do a couple of guys, in northern Canada have with no money, limited expertise, right?
No, it's true. It's a very
long shot.
Good point. Very good point. And look at Rio Tinto, for example. 2022, they had almost $60 billion in revenue. So you speak to how much cash they have and resources they have. They're locked and loaded to make things happen, and it still took them over 2 decades to get that into production.
To start construction, not production.
To start construction, yeah. Construction operating license, right? So it's not even production yet. But Rio Tinto, when you want to talk about the overall sentiment of the mining industry right now, and there's talk to people within the industry, and it's like, oh, it's just so bad out there. It's terrible, and yeah, it is. It's historically brutal right now for junior miners, but we all are anticipating the renewable wave is coming. EVs are coming. We're going to need, 5-6 times the amount of copper. And it's all true. It's all true. We are going to need an abundance of all these critical minerals. But let's take a look at Rio Tinto as our case in point. So one of the most important things to look at is how are the share prices doing of the majors? What's their PE ratios? This gives you a super good gauge of sentiment toward the overall sector. And unless they're robust, you're not going to see that trickle down into the junior miner space. So this is the example. This is why Rio Tinto is such a good example. In 2007, Rio Tinto had a PE ratio around 30. Okay? 30. Like, we're talking tech PE ratios. Today, it sits around between 12 and 13, I believe. When the markets are giving a company like Rio Tinto, which is one of the most preeminent mining companies in the last 50 years, they're giving them a 12 or 13 PE ratio. That means they're not extremely optimistic on the future growth of the company. It's exactly to your point. It takes almost 16 years to go from discovery to production.
Yeah.
So no matter what, no matter how good their assets are, the market's still like, this is like a decade, maybe longer away. I don't have that kind of time. If you look, and then you look at the correlation between the junior market. Yeah. So it has this trickle down effect. But at 12 or 13 for one of the world's biggest miners with a ton of, that company has amazing projects.
Yeah, they do. It tells me
that needs to increase before the juniors are going to start to see valuations increase. That's the long and short of it.
And that low PE tells me a couple things as well. The outlook for prices isn't as robust, right? In 2007, the story of China, it was never ending, right? That was before the crash. It was that you had this huge growth catalyst that was going to go on for decades, right? So sentiment was just sky high. What's the catalyst today? The other issue, 20, 30 years ago, you could go into a country, you could deal with the mining minister, a few key, political minds, and get it done, right? And you didn't have to take on 3 or 4 partners. You didn't have the political unrest, right, that we're seeing in places like Panama, with First Quantum and things like this. One of mining's huge Achilles heels is it's slow moving, right? Yeah. It's
slow moving in volatile cycles. The metals are naturally volatile, and yet the industry moves at a snail's pace.
Before you can print the money, it's hugely capital intensive up front, and you can't move the project. Elon Musk moved to Texas, okay? Yeah, it was a big hassle. He had to, relocate, build a new factory there and whatever, right? You can't move. Cobre Panamá, First Majestic cannot take that project and move it, to Colombia or to Peru or somewhere else that's going to be more favorable, from a tax perspective. Once you make that discovery, the government or the people can sink their teeth into you. Everybody wants a pound of flesh nowadays, right? There's no free lunches anymore.
There's risks in every country. And even if you go just down to the US, like it's the 5th or 6th largest copper producer in the world. It's a massive copper producer. Still has to import like half of its copper.
Yeah.
And you look at its most robust copper production state, which is Arizona, which produces like 70% of the nation's copper, they have arguably the largest copper mine, number 1 or number 2 probably. It's going to be right near Escondida if it ever goes into production. Sitting in Arizona, it's called the Resolution mine, and we've talked about it before, but it's been in the permitting process for more than 20 years. And this is the copper hub of America, and they still can't get it into production. The thing is massive. Whether you're in Africa or South America or the United States or Canada, they all have their challenges. They all have such long lead times from discovery to production that the industry, I think, is going to be stuck in a rut for quite some time unless metals prices skyrocket.
It comes back to your point of what type of investor am I? Am I going to be a discovery-focused investor, a resource calculation investor, or a production investor? Are you looking to speculate early? You have to have your timing and your window sorted out in your mind before you go into it and understand that you're not going to sit through this.
For me personally, I'm a speculator. I don't want to wait around for production. I like to bet big on true speculations, and as we know, and the expression in the industry is nothing pays like discovery. If you can be in on a greenfield play before discovery is made, chances are you're going to make more money doing that than if you bought during the development phase of the mine and waited for production. I believe. Yeah. And that's what I choose. That's the investor I choose to be.
You understand the risks associated with being that type of investor. You are going to strike out more times than not. But the right management team, the right project, when it connects, and the right market, if the cycle's with you, the returns can be explosive.
All right, so to wrap it up, mining investors need to decide, number one, what type of investor are you? Are you a discovery investor? Are you a development investor? Are you searching for production? These all impact the types of opportunities you should be looking for. Number two, the big question everybody's wondering these days is, when is the junior mining sector going to turn around? And I think one of the best gauges there is out there right now is the PE ratios of the majors. With the context of just looking at Rio Tinto, in 2007, the PE ratio was pushing 30, almost 30. 2016, I think it hit a low of somewhere around 6. Today, it stands at about 12-ish, maybe 13. So that gives you a good indication of where the overall industry is.
And keep an eye on financing activity, right? Until the price of some of these metals breaks out, I think it's going to remain relatively muted. But once that financing activity starts to go, once people see the gains and see gold break above 2100, 2200, until that happens, if it's trading sideways or in Lithium's case going down, investors are going to stay on the sidelines.
I think that about wraps it up. Thanks for tuning in. We'll see you next time.
Take care.